webinar on managing liquidity in a changing environment. I'm Marielle Barkley, editor of this award-winning Global Treasury Leaders Program, which is organized by The Economist Impact and sponsored by Deutsche Bank. The program's objective is twofold: to share thought leadership and to connect treasurers around the world. And we do this through a series of curated activities every year. These include summits in different regions, webinars like this one we're joining today, and an online community where we respond. It's open to corporates only, and this allows treasurers from all over the world to connect and exchange ideas on any topic of their interest. It is totally free. I'm now going to send you a link via the just remember to use the Global Treasury Leaders Network when asked what groups you would like to join. You can share via. Going back to today's webinar, the idea is to make this session as interactive as possible. So please ask as many questions as you would like using the questions tab on the right-hand side of your screen. And please send them to us as soon as you think of them, otherwise you will forget. We'll bring them up as appropriate. Without further ado, let me introduce the webinar's chair, Simon Jones, who is an independent treasury expert with ample experience both in the corporate and banking world, and who often chairs for Eurofinance, an economist company as well. With that, Simon will now introduce our speakers. Simon, over to you.
Thank you, Marielle, very much. Thank you for that introduction. And I'm absolutely delighted to be hosting and chairing this webinar today on a topic that I think is very close to everybody's hearts at the moment as corporate treasurers, managing liquidity, particularly in this very dynamic environment. We've seen interest rates increase at a breakneck pace that I certainly haven't seen in my career, the speed that we've seen interest rates go up. I've got a tremendous panel here of experts to join me to discuss this topic and get us up to speed as to where treasurers are handling these challenges at the moment. And I'd like each of them to introduce themselves. So first of all, Eric, then Rob, and then Sam. Over to you.
Thanks, Simon, and hi, everyone. My name is Eric DeVoe, and I'm very excited to be here today. I work in the corporate bank division of Deutsche Bank and am the global head of our liquidity product management organization. My team is responsible for the ongoing and successful delivery and development of our liquidity product capabilities and solutions. Additionally, we oversee the deposit and off-balance sheet investment portfolio of our corporate clients, which includes multinational corporates, mid-cap clients, and non-bank financial institutions, and more. I've been in the financial services industry for about 15 years, the past 5 with Deutsche Bank, prior to that 10 with JP Morgan. And essentially, I'm a product manager through and through. I've spent nearly my entire career in the discipline and to some extent covering liquidity products. So again, very happy to be here. Thanks for having me. And Simon, back to you.
Rob, over to you.
Hi, everyone. My name is Rob Westreich. I'm the Treasurer and Chief Tax Officer for Newell Brands. Newell Brands is a company, it's a US-based multinational that sells a lot of consumer discretionary products, something to the effect of Sharpie pens, Contigo cups, Yankee Candle, Coleman, and a variety of Rubbermaid and a variety of other products. We both manufacture and source finished goods from various other suppliers and sell them globally. I've been with Newell Brands now for approximately 7 years. At the onset, when Newell Brands became a company born from the merger of Jarden Corporation and Newell Rubbermaid. We have treasury teams that are in the US as well as in Western Europe, particularly in Ireland, and in Hong Kong, and we manage that activity on a global basis. And for us, liquidity is of particular importance because of the cycle of our business, whereabouts we are in the business of purchasing and making inventory in the early part of the year, and then we ship towards the back end of the year. And so we have a cash need at the beginning, and then we have a cash surplus at the end. So liquidity is a very important topic.
Sam, over to you.
Yeah, thanks, Simon. My name is Sam Balaton. I'm responsible for the treasury operations team at Salesforce. Salesforce is a company based in the US, in San Francisco. I'm myself based in Switzerland, but I just spent a lot of time in San Francisco. Salesforce is a software as a software as a service company. I mean, it's one of the tech companies, I guess, rising tech companies. We're doing some efforts to raise brand awareness. If you watch Formula One this year, you should have seen that blue cloud around some of the cars. Anyway, I've been with the company for about 13 years now, so the company is 24 years old. So there's been some tremendous changes over the last 13 years, and the treasury team, the company grew from when I joined. I think the revenue was about between $1 to $2 billion a year. Now the latest published numbers are about $31 billion. So the company grew, the treasury team grew. We have treasury operations team in the headquarters in San Francisco, in the US, working remotely, in Switzerland, and in Asia, mostly in Japan. Liquidity management is always top of mind. We have, as being software as a service company, obviously we have, let's say, a simplified list of tasks, in the sense there's no purchasing of raw material, transporting them, inventory management, but obviously the complexity of the liquidity management also impacts us greatly.
Great, thank you, Sam. Well, as you can see, we've got a really nice, diverse type of companies here in this very key topic, and some great experts to walk through this on with us. I'm going to go through a number of questions just to give the audience a reminder. Please ask questions through the chat. I will either ask the questions to the participants as we go through, or potentially save it till the end as we group up the questions. In order to make this interactive as well, we will have some poll questions for the audience as well. So be ready for that. There will be 2 poll questions that we will ask you to put up, and we'll try and put them up on the screen quite quickly. So without further ado, let me go into the first question. And Rob, I think you started off quite nicely with your introduction. Can you give us an insight into your company's business model and the way that impacts your liquidity across the company? You gave us some early insights into that, Robert, but perhaps a little more, and then I'll ask Sam after that. Thank you.
Sure. So as I alluded to before, our situation is that because of the nature of our business, so I'll give you one business in particular, which is our writing business. And our writing business is Sharpie pens, Papermate, Elmer's glue, Dymo labeling, and things to that effect. And what does that really, if you think about it, it's back to school, right? That's a big part of our business. So what we do in that particular business, and this is a good example of the rest of our businesses, is that we begin to manufacture our products and put our purchase orders out in the beginning of the year. What that means is we're either making it ourselves or we're buying it from third parties, depending upon the situation. And we're expending our liquidity, we're expending our cash to be able to go through this stuff. Because of the nature of the billing and the invoicing, the majority of our invoicing comes later in the year. So what will happen is we'll go through Q1 and parts of Q2 on a cash use basis, where we're spending a lot of this money, and we're not having it come in yet. But then we begin to ship, call it June, end of Q2, Q3, and then that's when you begin to see the turnaround. So what happens is we start with a cash use mode in the beginning of the year, and then we ship, and then we begin to collect most of our cash at the back end of the year. So for us, that period of time we're in a cash use is critical for us to have liquidity tools to do that. So we have a variety of liquidity tools, right? We had our credit revolver is one tool. We had the commercial paper market that we were utilizing, that was another tool. We have an AR securitization program where we also used, which is really a collateralized way to borrow on a short-term basis. And then we also have a factoring program where we factor certain customer receivables at some discount to be able to bring cash in quick. So instead of dealing with a a 60-day DSO type of situation for getting the cash. So we've looked at, and of course, in each of these tools, we look at the cost of those tools. So before the change in the economy, when rates were very low, it was pretty easy to navigate through each of these liquidity tools because the cost of money was a lot smaller. Now it's a very different situation, and we're much more mindful about how we tap and utilize our liquidity tools based on this cost methodology and also based upon our need to expend the cash and from a timing perspective. So the business model facilitates the liquidity strategy, and we come up with a pretty good solution.
Thank you, Rob. Really interesting, and clearly interest rate costs have dramatically changed, which has clearly made you far more laser focused on this as you've been consuming cash in the first 2 quarters going forward. Sam, your business model is very different. Talk us through how you're impacted.
So we're a software as a service company. Our core product is a CRM. We also have some other products that you might be familiar with, like Tableau or Slack. The gist of the business model really is the same all across the different products, and fairly simple. We're subscription based, and typically the way it works, I mean, we provide incentives for customers to pay us upfront the entire subscription for the duration of the subscription. So that makes it very, I'd say, appealing from a cash perspective. We're definitely cash flow positive. We do have a revolver. We do have some debt as well, but we don't have a commercial paper program. We don't do factoring. So overall, I'm cash flow positive, fueled mostly by the subscription-based model, which allows us to be positive and also to already know in advance future revenue.
Great, thanks, Sam. So let's go to the next question then. And Eric, I'd like to ask you this particular one. Over the last year, as we've seen, companies have had to react to unprecedented interest rate rises. How have you seen clients changing their liquidity management, in particularly the last 12, 18 months?
Sure, thanks, Simon. And before diving into the aspect of change, just want to first start and highlight that certain fundamentals certainly remain intact for liquidity management, right? As we've just heard from Rob and Sam, a deep understanding of your business model and the resultant cash flows that creates remains of paramount importance. Being able to understand the predictability and reliability of your inflows, any seasonality, having strong cash flow forecasting processes in place, understanding your payroll runs, your one-off specific payments like dividend, tax, or CapEx, forming that complete cash flow picture and having good control over that is absolutely fundamental for cash segmentation and investment horizon planning, right? So I think that's first and foremost something that definitely remains top of mind for corporate treasurers. Additionally, looking at some of the changes, I think the first observation I'd have, and I think, Rob, you touched on it as well, is that the opportunity cost from inefficient liquidity management and idle cash is increasing, right? And what we've seen from corporates in response to that is that clients are really looking at their in-house bank arrangements or cash pooling arrangements, these centralized treasury structures, which really help to mobilize cash for the various different investment opportunities, financing, or debt repayments. So we've seen particularly much interest in multi-currency and other workflow solutions that help to increase the amount of participating entities in those types of solutions, address specific inefficiencies, as well as capitalize on those opportunities. Again, supporting those treasury centralized structures, mobilizing cash, and ultimately reducing the amount of idle balances, which ultimately not be put to good use. My next set of observations relates to how excess cash is actually deployed across the investment vehicle spectrum of bank deposits and other off-balance sheet alternative investment vehicles. The first being, we've seen a shift in bank deposits, particularly in the composition from overnight to term, we've seen, and the reason for that is clearly the yield potential on term deposits is higher than that of overnight. Just a couple of statistics, right? So not only have we seen this in Deutsche Bank, but within the market, if you look at Euro area banks, corporate TDs has more than doubled in the past 12 months, increasing over 300 billion euros. And equally over the same period, overnight deposits has roughly decreased by that same amount. And if you look at the US market throughout 2022, while overall FDIC insured bank deposits has decreased by 500 billion, TDs has increased by 400 billion as well, right? So we see that general trend across the industry. My next observation would be around that preferences for different TD tenors continues to evolve. Say late Q3, Q4 last year, corporates were tending to be opportunistic, looking to extend tenors and take advantage of higher yields on that aspect of banks' pricing. However, more recently, as of late, since say last or late Q1, we've seen that trend reverse a little bit where corporates are looking to stay more on the shorter side of the cash equivalent spectrum, really prioritizing access to liquidity and yield, access to liquidity and safety over yield. Right? I think there's a couple of drivers and reasons for that. The first, back in the early aspects of the interest rate cycle, when you had significant expectation for steep and fast increases in interest rates, and we were still kind of at the beginning of that IR cycle, the actual yield pickup opportunity on longer dated TDs versus shorter dated TDs, it was just much greater than where it is today. Right? So I think that was somewhat driving the behavior. Additionally, when you overlay the counterparty risk considerations that I think have been brewing in the industry and are getting more and more focus, the combination of those two factors are leading towards a trend towards shorter tenor TDs. Additionally, and I think of no surprise, especially early on, there was a key preference towards floating interest rate constructs, right? So different deposit products like call notice deposits, floating rates on sight deposits. So these investment vehicles that allow for participation in the increasing rate environment was certainly a big trend early on in terms of preference. I think that is muted a bit right now that we expect to be near the peak of the IR cycle and hasn't been as big of a focus or demand. That was certainly a trend that we observed over the past 12 months. And last but not least, certainly an increasing focus on alternative investment vehicles to bank deposits, right? Particularly, there's been interest in money market mutual funds and reverse repo as other options to deploy cash. I think, again, a few reasons for this. First, especially when you look at the overnight tranche, money funds and reverse repo definitely have yield pickup opportunity compared to bank deposits. Second, when you look at the expansionary fiscal and monetary policies that were in place during the start of COVID, that really led to an unprecedented surge in savings and bank deposits, and also a slowdown in credit availability. Net, you had a lot of excess cash and liquidity in the market, and there needed to be some place to deploy that beyond bank deposits. Coupling that with some of the comments I just made on counterparty risk and how limits and exposures are being looked at, those three things I think in combined really have drummed up interest for some of these additional vehicles. One parting statistic just on the money market fund market in the US, from Q1 2022 to Q1 2023 period end, the assets in money funds increased by about 600 billion or 12% as well. So clearly we see that going through the market as well.
Okay, thanks very much, Eric. That was great. Particularly a statistic that caught my attention was around the shift to time deposits. And I think that leads well on to my next question. What I was thinking is that if corporate treasuries are using time deposits more because of the interest rate environment, that puts a lot of pressure on making sure you're planning, your liquidity planning and your cash flow forecasting is super accurate. Otherwise, you're going to have time deposits, not having matured when you need the cash, which I think we haven't had that environment for a good couple of years. So that brings me on to a question around technology. And what technology, instruments, and techniques are the treasuries using, and are there any lessons learned? Are there any new instruments that you're investing in? Are there any lessons learned that will be insightful from this panel? So first of all, Rob, let's go to you on that question.
Sure. Well, it's a big question, and let me see if I can kind of compartmentalize it in an appropriate way. So just from a technology perspective, because we were a company of a lot of different acquisitions that took some time to integrate, we have been on a mission now for the last year and a half or so to implement SAP Treasury across the world. And because we're an SAP shop, it just made a lot of sense that whether it's the best, Treasury workstation. But what was interesting about that was that it had a lot of the tools it had a lot of the ability to support the tools that we use. So for instance, and some of the things that, I think Eric had mentioned before is that one of the big tools that we use are notional cash pools. So we have outside the US, we have notional cash pools that allow a lot of multi-currency companies to participate to be able to deposit their local currency cash into a pool that we can then redeploy that cash within the group, so that a euro company can deposit excess cash and a yen company can draw the cash down, where the pool operator or the bank is the one managing the FX risk. Okay. And again, the system our SAP Treasury will be the facilitator of that, so that the objective is, and as I mentioned before, we have an Irish Treasury Center. That's our in-house bank, and they're the ones that are kind of managing the activity there. Another tool that we use is we call the netting center. So we have a process whereby we do a lot of intercompany transactions. We have manufacturing companies, we have distribution companies and holding companies and whatnot, and then what we did in IP companies, and then we try to move those intercompany transactions through the netting center, so that again, because of the multi-currency approach, we then take that net position and then we hedge that net position to avoid the FX exposure. In other areas, we are very proactive from a repatriation perspective. So again, the objective for us is that how do we use different techniques to bring the cash back to where we need it? And so repatriation is another approach, and because I wear the tax hat for the company as well, there's the ability to kind of navigate through the different perspectives between the treasury function and the tax function, so that we can, on a consolidated basis, achieve a repatriation that's both tax efficient and good for the company. Now, the reason why we're repatriating cash back to the US is that for us, our external debt is all US based. So whether that's our public bonds that are issued or our short-term liquidity needs. So what happens then is that in the beginning of the year, as I said before, when we're on a cash needs basis, we're going to be increasing the balances of drawing down on these various liquidity tools. So we want to make sure that we use whatever excess cash that's in the system to be able to keep repaying that to minimize the interest cost for the company. Another thing that we do too is, as I said before, we have a factoring program and we have an AR securitization program. So sometimes those are at odds with each other, because one is used simply just to factor and sell to the bank, and the other one is used as collateral to borrow against. So what we've done, because we've done an analysis, and the factoring program provides us a better return or a lower cost than the AR securitization. So what we do is that we manage specific customers into the factoring program, and then specific customers into the AR securitization program. So the systems allow us to bifurcate the invoicing as to where it goes, to be able to, again, maximize our ability to tap each of those particular liquidity tools. So, and again, because there's so much going on all at the same time, it makes a lot of sense for us to have one consistent workstation where my team can either work at it from the US headquarters, the European headquarters, the Hong Kong, their homes, whatever the case may be, to be able to manage this on a go-forward basis. So it's that's what's been working for us, and we've been on a mission now to enhance this as further as possible.
Great. Thanks, Rob. You know, clearly you've invested a lot in the integration of the systems and in using, you know, SAP Treasury extensively, and also very interesting to hear how you've got different, you know, debt programs that you can access, and you can actually bifurcate them. You know, again, you need really good systems and technology to be able to do that. Sam, what about from your perspective, you know, how you collect all those subscriptions and how you bring that together into the center? Be great to hear that from you.
Sure. I think we have fairly what I would call traditional setup, in the sense we have a TMS that helps us manage daily cash positioning, daily cash liquidity needs. Our TMS is connected directly to all the banks through SWIFT. We have our own big code, and we use it for either reporting or processing payments out of the TMS. Our TMS also allows us to track intercompany positions, which means, I mean, it's the main tool for our NAS bank. I'd say we've looked, and as far as when it comes to technology, we've looked into API. You know, it's obviously, I mean, let's say a term that's been mentioned by the banks over the last, I'd say, I don't know, 2-3 years, maybe even more. It's something definitely, I think, that has value. Whether it has value for us yet, that's another question, in the sense that we're a B2B company. So the real-time information is not top of mind at the moment. I'm sure that at some point in the future, we'll be able to put that, let's say, in our top 3 priorities. But at the moment, we just go through SWIFT, mostly to connect with the banks. And when it comes to investment, we're going to use different investments platform like ICD that helps us consolidate and dispatch orders. We're fairly, I'd say, again, I think, plain vanilla. You know, we're going to have money market funds available, and depending on the size of investment, obviously, as soon as we can switch to an SMA, that's what we're going to do. We have SMAs in place in the US for USD. We have SMAs in place in Europe for Euro. And I'd say that we also have overnight agreements with the banks where we keep most of our, I'd say, operating capital. One thing I wanted to mention concerning the shift that we did recently on the SMA, we did shorten the average maturity of the instruments we have in there to less than a year, but we're now seeing appropriate compensation for longer, so we're going back longer a little bit more now.
Simon, I also wanted to mention something else that I failed to mention, because and I want to just be clear that we talk about liquidity, right? But liquidity is really 2 things to me. It's the tools, right, and all the things that, you know, Sam and I mentioned. But then there's the other aspect, which is really your forecasting, right? And I can't stress enough how important the forecasting is, because the forecasting is going to tell you the need, then the need is going to tell you the tool to utilize. And you know, we certainly put a tremendous amount of effort on forecasting, which is a daily forecast, and then we do a 12-month rolling forecast to be able to get an idea. And once you get into that cadence of that kind of forecasting, you then have a much clearer view as to the tools that you'd be utilizing.
Yeah, just adding to that, also cash flow forecasting is definitely key for us as well. You know, we have a rolling forecast for short term, but also for long term. And that, you know, even though we're subscription based, let's say, we do have some seasonality in the influx of cash. So it's very important for us to be able to kind of plan for short and long term as well.
I couldn't agree with you more, Sam and Rob, and I think we kind of touched on it with the maturities. You know, obviously your debt instruments, you know, Rob, but also Sam, I thought that was very useful comment, very useful insight with regard to your investment strategies, your investment mandates. That, you know, back to Eric's point, that people have been using longer dated. And, you know, starting to move back to shorter dated now. Now we're at the top of the interest rate cycle, and you absolutely confirm that, which I think is great. Now we want to put a poll question up, and I think get us thinking about investment policies and how that might have changed in this current environment. So we're going to put up a poll question and ask the audience, when was the last time you reviewed and updated your investment policy? That's not, if we go, Kendall, can you go back to the other one? Thank you. We'll share that one. There we go, brilliant. So if you could just, the audience, just select an answer for that, and we'll quickly come round and see the results on. I think particularly with counterparty risk being top of mind, a lot more diversity in instruments that I think corporates are using. We wanted to make sure we get a bit of a read from the audience as to what you've been doing on your investment policy, or maybe you've been tested it in this current environment, and actually it's come out very well, and you haven't had to make any changes, which is also good. Okay, can we see if we've got any answers from that, Kendall? Brilliant. Okay, interesting. So nobody's rushed. So the consensus of opinion here is that most people haven't reviewed this for more than 12 months, which sounds like there hasn't been a sort of a mad rush to update the policies in the last 12 months or so. Some people have updated them in the last 3 months, 23%, and then within the last 12 months, another 23% as well. So it's good to see that there's a nice mix of not everybody having to make, what I would say quite dramatic changes to the investment policy going forward. Eric, maybe any comments on that from yourself, what you see from those results? Is that consistent with what you see from clients?
Yeah, it's interesting to see how evenly dispersed it is, mainly. I mean, I would have loved to ask this question and get the same sort of answers this time last year to see how it's changed, but I think this is largely consistent with what we're seeing.
Great. Any thoughts, Sam or Rob?
I'd say I'm not surprised. I mean, I guess if I had to answer, I would have probably answered, I don't know. And really, what I mean by that is that I think the raising interest rates, I mean, the concern for counterparty risk, I mean, to me, those have not really changed our priorities. And the investment policy that was in place before the last 12 months, I mean, it had no reason to be updated for what was going on. I think, as a U.S. corporate, I'd like most corporate actually, we have an appetite for increased yield, but that's always mitigated or dumbed down by we don't want risk. We want to push away risk as much as possible. So that means, that let's say the attraction of a higher yield is always, I'd say, the expectation is always, I'd say, reasonable. We don't want to take risks and I'd say also something I mentioned last week. I mean, given the latest news, let's say in the tech world, a lot of restructuring happening in the tech companies. I mean, a lot of companies over the last six months had to do some layoffs and cut costs, which is also our case in our current phase of growth. I mean, there's, let's say, less focus on cash flow and more focus on profitability. So being in that environment, let's say maximize yield, there is not as much rewarded as cutting fees. So there's more focus on our end to kind of see what we can do to reduce bank fees. Sorry, Eric. But that's, yeah, the sense, definitely that's one of the push. Reducing bank fees seems to be getting more attention and more rewarding than actually keeping the yield up and up.
And Rob, any thoughts on the answers?
Well, we do have an investment policy in place, but our investment policy is, I'm not going to say generic, but it's a little more flexible so that we have the right controls in place, but we don't specify specifics that you're only allowed to achieve this certain amount of yield or this particular thing. We talk more about credit quality type of investments to make sure that makes sense. But we've operated under the concept of, with cash, it's security, liquidity, and then yield, right? So we of course would like to maximize our yield, but we understand that the cash for us is better used to reinvest into the business. That's where we're going to get the best yield. So we have to manage that in that particular fashion. So the policy, although it's been done and put in place, some time ago, it's flexible enough to deal with the change in the environment where we don't have to be. And again, that's really depends on how you write your policy too. But I would say that the percentage difference in the answers is probably representative of the kinds of companies that are voting as well. Because Sam's business is much more of a cash-rich business than my business, so we would have a very different kind of approach. Whereas, and also too, whether you're a private company, you're a publicly traded company, and so on and so forth.
Yeah, I couldn't agree more, and it's good to see there's some stability in the way the investment policy has been stable, and both of you represent clearly very prudent treasurers, which is what the industry wants to see absolutely going forward. Now that gets us really into the counterparty risk question that I'd like to put forward. We've touched on some of this, but clearly, with the recent events in the US banking system, counterparty risk has been a key topic in the last few months and the last year or so. And as a result of those events, how have each of you, tweaked? I think you gave good insight, Robert, into the fact that your policy is quite flexible, but have you really made any tweaks in your investment policy, in your counterparty risk policy within your investment policy, taking into account events, or have they stood up well to events? So maybe Sam, start with you.
Yeah, I guess similar answers than before in the sense, we already, I guess the general mindset is to be very risk averse, no matter what. So, you want to have some healthy level of paranoia, like somebody mentioned in the conference once. I'd say counterparty risk, the limits for each bank, for each counterparty is actually not clearly defined in the policy. It's kind of up to the moment in sense, up to the treasurer, up to the CFO. We communicate obviously at the different levels of exposure with each different bank. So, but clearly we look closely at the balance sheet of each counterparty. I'd say the impact of what happened earlier this year, obviously, we didn't have much exposure in any of the banks that unfortunately had issues, but the impact is that we want to make sure that we have zero exposure with the bank at risk. So to us, that's a clear decision, or that's let's say the clear impact. What happened earlier this year is like, normally we want to minimize exposure, we want to eliminate exposure with the banks at risk.
And Rob, your thoughts on that, on counterparty risk? I think you've touched on quite a bit of it already.
Well, I think when you set your counterparty risk policy, you should always be anticipating the question when a CFO or a CEO reads in the paper about a bank having challenges, like some of the West Coast banks that happened recently. The first question you're going to get asked is, do we have exposure, and who else do we have to worry about, and so on and so forth, right? So I think that what we do is the way that we kind of operate is that we look at our bank group with our credit revolver, right? And that's the group that we do our principal amount of business with, okay? Because there's a commitment from them, and then we, of course, choose the right banks to be able to do all the kind of transactions that we look to do, right? So, but those banks still, because we're doing a lot of different kinds of business with them, we do have a counterparty risk policy that limits the exposure that we have to a particular bank. So we could have with banks foreign exchange work, we could have a term loan, we could have a variety of different deposits, a variety of different situations that we have to monitor. So we monitor our counterparty risk every month, right? Because of the constant fluctuation in the business. Because for instance, in foreign exchange, we don't just go to a particular bank. It's really a bidded out work. So whoever gives the best price, that's where we're going to be doing the transaction. And we have a very robust foreign exchange program, derivative program internally. So I think, I think Sam may have said it before, we don't necessarily tie the counterparty risk to the investment policy. One has to live with the other. And I think that if your perspective on counterparty risk is appropriate, then when things like the recent bank issues are not going to be a problem for you, or at least won't be a significant problem for you.
Great, thanks, Rob. What was very key, I think, around your counterparty risk for both of you is that there's some flexibility around it. You're monitoring it, but it's not so rigid from the board that you can't make quick changes, you can't adapt quickly. And I think that's a really good point for everyone. You need to have that flexibility, because these things can be very dynamic, and it's not about waiting for the next board meeting when something's going to be changed. And you're absolutely right. That question from the CFO is going to come down the line very quickly when stuff hits the press, or hopefully you're way ahead of that anyway, which it sounds like both of you are. Now let's go to another audience poll. If we could put that up on the screen. Thinking about the topic around different instruments, it'd be great to have a poll from the audience to understand, in the current environment of managing short-term liquidity, what instruments are you using, or are you using a mix of all of them? It'd be great to have a sense. Obviously, we have a great variety of companies on the line, so have a quick think of that, and we'll see if this has changed very dramatically or not in the last 12 months. Okay, can we put up the answers? Everybody should be quite quick. There we go, brilliant. Great, so still we have very prudent traditional bank deposits and high yielding accounts, some commercial paper investments, 42% for money market funds. That's interesting, Eric. I think probably back to your your earlier comments, that probably has increased, I would say. And interestingly, nobody using repos, which we have started to hear people talking about using repos, but interestingly, it tends to be the really larger corporate treasuries. And as we would expect, 13% of a mix of all of the above, so maybe some of the repos are captured within that. Eric, do you want to give any comments on that?
No, I'd agree with your assessment, Simon. The uptick in money funds, I think, is showing through the data. Repos, a little surprising to see 0, but as you said, I think, and especially compared to money funds, it is an emerging investment vehicle option. I think we're seeing the interest increase, albeit it's still in its nascent stages.
Yeah. Okay, let's quickly move on to the next question. Eric, to you, we've clearly seen this change in demand. We've seen money market funds being used more. We've seen much more focus on cash flow forecasting, liquidity, liberation, I would say, from around the world, greater opportunity lost if you don't. And what new solutions have you been investing in and you brought to market in the last 12 months to sort of meet some of this demand that you've been seeing?
Yeah, so the key solution that I'd like to highlight in response to the changing client demand we've seen is what we refer to as our cash investment service, or CIS for short. And CIS is our agency investment solution, where we provide clients access to investment vehicles that are alternatives to bank deposits. So notably, that would be opportunity to invest through our agency trading desk according to investment rules you define, the ability to go into various different money market funds, right, of underlying different holdings, different fund characteristics. But I think equally interesting, through the platform, clients have the ability to invest in reverse repos through over 50 different counterparties that we offer through the platform. And I think reverse repo, while we still see 0% in the poll, I think it's particularly interesting to talk about and through our CIS platform, because it really challenges, I think, some of the traditional trade-offs you see between safety, liquidity, and yield, as there's some unique configurations within the overall solution. And just to touch on a few of those quickly, looking at safety, right? Not only would a client investing through the solution be able to select their range of counterparties, but they're also able to select what we call different collateral baskets, right? And these collateral baskets range in terms of different risk profiles, from something, super safe, AAA rated government fixed income debt, to the other end of the spectrum where you could be looking at, specific equities, right? So the first thing to recognize is that these reverse repo solutions, you can almost think of it as like a collateralized deposit, right? Where you're exchanging cash and receiving some form of securities collateral back. Further, that collateral basket is then over collateralized based on the risk profile of the collateral basket chosen. So if you wanted to go with a less risky collateral basket, the amount of over collateralization required would be less than that of, say, an equities basket, right? But the intent and design of this is really to prioritize, and we've heard it, Sam, Rob, right? That need for principal preservation. This helps achieve that by over collateralizing the securities against your cash investment. And lastly, let's say in the event your counterparty that you entered into this repo arrangement was insolvent, and the collateral basket fair value of the securities, which by the way is marked to market daily with daily margin calls, if that was a shortfall to your cash investment, Deutsche Bank actually steps in with a shortfall indemnity and would make you whole in the event the counterparty is insolvent and the liquidation value of the securities is less than the cash investment amount. So I think embedded in the solution is a really strong degree of principal preservation, and we have multiple layers of ways in which we achieve that. Just to kind of round it out, when you look at the yield and tenor options, those range from overnight to 3 months to even longer. We've got a variety of different trade options, whether they be kind of one-off bullet trades, extendable, or even open-ended constructs. And based off of these variety of risk and liquidity factors, right, that will have a direct impact on the amount of yield that you can get, right, which we generally see as fairly competitive, right, overnight reference rates, less X, right, driven by some of the actual decision factors that would be going into how you configure kind of where you land on the spectrum of those various different considerations.
Thanks, Eric. And so clearly treasurers are getting involved with many more instruments in managing their liquidity positions, and you're really bringing platforms to the market to help simplify that for them, going forward, which is, I think, great and really, really good to hear. Now, we have got some questions coming in, and I'm going to go for the first one. So we've got a question on Pillar 2. So interested in discussing the impact of Pillar 2, and I think this is for you, Eric, and global liquidity mechanisms via cash pooling. So with global liquidity, with Basel rules, etc., around Pillar 2, what has been the impact to your cash pooling solutions, or if not, if any? It would be great to hear.
Yeah, admittedly, we haven't seen a ton of impact from that actually flow through to our cash pooling solutions yet, but I think it's something that we'll continue to monitor and keep an eye on.
We can't hear you, Simon. I think
Simon, we can't hear you.
Okay, can you hear me now? Okay,
Yes.
great.
Yes.
Okay, next question I've got is a crypto question. Will cryptocurrency play any real role in the treasury function, considering good ETFs are lined up for approval with the SEC? How long may it take for crypto to be regulated, or will it ever be regulated? Maybe first of all to Eric, and then maybe quick view from the corporate treasurers after that as well. So Eric, first to you. Sorry to come to you again.
So certainly not my area of expertise. I mean, I think what's interesting to see, right, is the regulation that is coming down on the crypto market, right, that the treatment of it as either a security or not, right, and the implications that would have in terms of being able to deal in crypto, hold it from a custody perspective, and other considerations such as that. Certainly there's a lot of, and you see it, the central bank digital currency aspects, right? I mean, kind of as an aside to the traditional, more decentralized crypto that is, clearly gaining momentum as well.
No, you're still
we
muted,
can't hear you.
Simon.
Sam, any thoughts from you?
Oh yeah, plenty of thoughts on crypto. Not sure we have
Me
the
too
time.
as well.
No, I think as every currency, I think you can always go back to the fact that the one of the principle behind it, any type of currency is called, we call fiduciary. So in a sense, a certain level of faith to the currency. So that being said, so it depends on how much faith you actually have in crypto. That being said, you hear a lot of presentations and seminars on crypto. I think all of it is very interesting and very educational. I think there's a clear path forward at some point to implement, a crypto that is either backed by a central bank or a group of banks. At some point, for the immediate future, I'd say we are not planning anything around it.
Yeah, and Rob, anything from any thoughts from you?
Yeah, we have zero interest in participating in crypto, right?
Yeah.
Frankly speaking, the investment policy would preclude us from doing it, right?
Yeah.
And I think that again shows you that it's good to have a flexible enough policy so that when something is fashionable now, okay, we could take a look at it a little more, objectively to see, does it really make sense for the organization? And then, not to mention the fact I still don't understand crypto, so I can't recommend it yet.
I would agree with you all, and I think we have to take a watching brief around commercial bank issued stable coins, deposit tokens that I think we're going to start to see on blockchains, and CBDCs as Eric mentioned, that's going to start to be a thing. But until that happens, yeah, I agree with you. Keep well clear from it. My experience as well. Let's just go for one final question. We have, oh no, we don't actually have another question, unless I've missed it. I don't think we do. So I think
Simon, I don't know if you'd like me to share it with you or if you'd like to close, but we have a couple of questions.
You do have a couple more questions. Maybe you could share them with me.
Yes, so one is will there be again increase in interest rate by the Fed in the next 6 months?
Yeah, got it. So will there be an increase of interest rates by the Fed in the next 6 months? Don't want anybody to give any predictions here, but I think let's just sort of sum it up as to do we think we're at the top of the interest rate cycle here, or do we think there's more to still go? Maybe Rob and Sam, maybe your views first of all.
Well, we've forecasted for the U.S. rate to have 2 more increases of 25 basis points each. We've just included that in our forecast. Hopefully it's conservative, and then that will be that if it happens at all. But we are also forecasting increases in the European community and the UK community as well. And we believe that the rates outside the US will grow faster proportionally. And we're getting that from banks and economists and whatnot, just to getting a feel for it.
Yeah, I would agree with that. And Sam, your thoughts?
Probably similar to Rob. I think that we don't have, like, let's say, a strong position, strong company position, but I mean, there's a personal position. I do think that, you know, 2 more increases at quarter point, I mean, do make sense, and it's all about having the ability to pivot and take advantage of the market. You know, you need the tools to be able to kind of adapt to the situations. Yeah, but not much more to say there. Yeah.
Okay, and Eric, any thoughts? Don't need to give any your economist predictions, but you know, just where you feel roughly we are in the cycle.
Yeah, I mean, just even looking at comments coming out from the various central banks or the actions that they're taking, right? It kind of depends where in the world you are. I think the market in the US largely expects maybe 1 to 2 more 25 bips hikes. Euro kind of playing a little bit more of catch up, maybe a little bit higher, right, than that in terms of an increase, but not much likely. I mean, if you look at China, for example, though, they are cutting rates, right, for renminbi. So it's interesting to see where different, you know, governments are, different currencies, economies are in the cycle, and the different actions that they're taking. But something that we all, you know, continuously monitor, obviously, very closely.
Yeah, I agree with you, Rob and Sam. They're around, you know, we may see a slowing in the US, but I agree with you. I think we've still got a lot more to come in Europe and particularly the UK, you know, to come from a rates perspective. So clearly a very different environment than we've even had in the last, you know, 10 years, really. I think is what we're living through at the moment. But anyway, I think this has been a terrific session. Thank you very much to the panelists, and thank you very much to the audience, to the great questions. Hopefully we got them. And I'll hand back to Marielle to close the session for us. Thank you, Marielle.
On the contrary, thank you so much, Simon. First of all, I wanted to thank you and give some information on the upcoming activities. Thank also Sam, Eric, and Robert for sharing your experience and best practice. And thank you, Deutsche Bank, for making this event possible. I also want to thank you all for being here. I hope you found the session helpful. Please feel free to continue this conversation with the speakers and colleagues at the Global Treasury Leaders community. You can join using the link I shared with you earlier on the chat. And through that platform, as I mentioned, you can exchange experiences, ask questions to all the members, and we share content on a regular basis. So we'll put that link again in the chat. The next webinar will be on managing trapped cash in complex markets. Again, very topical in the current circumstances. So please watch out for our emails. We'll be sharing more information shortly. Thank you very much all again, and I hope to see you again soon. Goodbye.
Thanks, everyone. Bye-bye.
Thank you.
Bye-bye.